Welcome to Cashcraft Finance, and if you have any amount of money in the market whatsoever, you're going to want to hear this. Over the last few days, the S&P 500 briefly turned negative for the year. Bitcoin saw its largest outflow since 2021, officially placing it in a bear market. Trump's tariffs are suspected to soon go into effect, and all of this is about to have a major impact on our entire economy, including how much money you're about to make or lose if you're not careful. This is why we have to talk about exactly what's happening, what you could expect in the future, why Warren Buffett just sold the S&P 500, and why most people are soon about to be in for a very rude awakening. Because even though it's easy to think low prices are awesome, I'll buy everything at a discount, this is great, the truth is most people are not prepared for when they witness serious, life-changing losses in their account, when years' worth of savings are wiped away over a matter of weeks and months. And that is what I want to talk about in today's video, along with the best strategies that you could use going forward to stay profitable, as long as you hit the like button and subscribe if you haven't done that already. So thanks so much, and also big thank you to ZipRecruiter for sponsoring this video, but more on that later. Alright, so to start, in terms of why the market's beginning to sell off, it's pretty straightforward. Number one, we have Trump tariffs. The thinking with this is that if imported goods become more expensive, as in you apply a tariff to them, it's going to encourage people to manufacture and buy products locally, thereby helping the economy. And if they don't do that, then additional revenue is collected in the process, or at least that's just what should happen. Now in the past, this has always been used as a bit of a negotiation tactic, with them finding a way to magically delay tariffs at the last possible moment. But this time could be different. If enacted, this could have four main consequences for practically everybody, and the first being higher prices. After all, independent groups have estimated that the proposed tariffs would end up costing the average American family an extra $2,000 to $4,000 annually. Or there's also the chance for number two, retaliation from other countries. Like just imagine you've been doing business with a country for decades, and then out of nowhere, they issue a tariff on your goods. Who's to say they won't retaliate by issuing a tariff on our goods, starting an all-out global trade war? This results in three, a decline in economic growth. At this point, one country charging more because the other country is charging more simply starts a downward cycle where people cut back. They spend less, they make less money, and our economy shrinks, all because we're in a game of chicken to see which country blinks first. And fourth, less competition could in a way lead to less innovation. Like it's not a surprise that foreign goods are often cheaper because they lack the payroll, regulation, or oversight that we have in the United States. But that also means that our goods need to be that much better to be able to justify much higher prices. This is why so far the stock market's reacted pretty negatively to tariffs, or really any uncertainty is going to cause prices to begin selling off, which leads us to number two, major losses. See, even though you might have noticed that the S&P 500 has done incredibly well over these last few years, the reality is that only 28% of stocks within the S&P 500 are actually beating the index, meaning the vast majority of profits are simply due to the largest 7 companies doing incredibly well. And this type of concentration really hasn't been seen since 1998 and 99, right before the dot-com bubble. In fact, if you want some crazy statistics, those 7 companies make up 35% of the entire index, and the top 3 companies drive nearly half of all profits. So when they begin selling off, the entire market begins selling off right alongside with them. So why are they selling off? Well, it's become a bit apparent that revenue is slowing down. Growth might begin to level off over these next few years. And that means maybe people got a bit too excited about the buzzwords of AI. Perhaps they pulled forward a lot of the future growth to today's prices. And it could be that maybe the market's beginning to normalize. In fact, even the Wall Street Journal talked about the risks of today's markets fueled by artificial intelligence, and comparing it to that of Cisco in the early 2000s. Now that's not to say that stock prices are going to fall 50%, but it does give us a clear reason that when those 7 stocks fall, including Tesla dropping 40% from the peak, the rest of the index is going to fall right alongside with it. Which then leads us to the next issue. Number 3, the Federal Reserve. This is because they largely control the amount of money that goes into and out of our economy based on inflation. And over the last year, the hope is that they would start aggressively cutting interest rates now that inflation is almost back to their 2% target, but that no longer appears to be the case. As of a few weeks ago, Jerome Powell went on record to say that there's no need to rush interest rate cut, and there's the very real concern that tariffs could actually cause prices to begin going higher, causing prices to remain elevated. This means the market is pricing in the likelihood that rates remain higher for longer than expected, and we're unlikely to see any significant rate cuts anytime soon. On top of that, there have also been some recent concerns about a term that we have not talked about here on the channel in years: stagflation. This occurs when prices remain high during a time where unemployment increases, and right now could be the perfect storm. Of course, on the flip side, consumer confidence did fall to its lowest level since 2021, signaling that people are worried about our economy, they're concerned about their future income, and that could result in people spending less money, which would allow the Federal Reserve to start cutting rates. Although in terms of what this means for you, what you could do about it, and how you could protect yourself from rather large sell-offs, here's what you came for, because it might be surprised. But first of all, before we go into that, if you run a business, now could be a very challenging time, which is why it's incredibly important now, more than ever, to hire the right people. Like I could say, as someone who runs a small team, each person plays a crucial role in finishing the finalized product. And if one small detail falls behind, everybody gets delayed. That's why in this economy, if you want to get ahead, you have to find your next hire as fast as possible without sifting through unqualified candidates. And one of the ways you could do that is with our sponsor, ZipRecruiter. Now, before we go into the practical steps that you could begin taking today to make sure you come out ahead profitable, there is one more topic that I want to talk about, and that would be cryptocurrency. Over the last few weeks, Bitcoin has fallen from its high of $108,000 down to currently around $80,000, a drop of nearly 25% and a signal that we are in a Bitcoin bear market. Why? Well, on the surface, it's not uncommon for Bitcoin to track the overall movement of the stock market. For instance, over the last 6 years, it's nearly identical to a triple leveraged NASDAQ, meaning when the market moves up or down, Bitcoin trades right alongside with it. So what we're seeing today is not unusual whatsoever. Separate from that, there's also some of the reality that the Trump excitement is beginning to wear off. Like, we've yet to see any sort of Bitcoin reserve. The SEC has already ended its lawsuits and allegations against major exchanges. They've given guidance that most meme coins aren't securities. If something new happens, a lot of the anticipation is beginning to settle down. This leads a lot of traders to believe that it could continue trending downwards until it finds its footing, which some say could be in the mid $60,000 to $70,000 range. Although if we just take a moment to see the bigger picture, you'll come to realize that this isn't anywhere close to being one of the biggest drops we've ever seen. Like, this is just another day. Seasoned cryptocurrency investors, where they could lose anywhere from 20 to 80% of their investment in a short period of time before it eventually rebounds and hits another all-time high. This is why people always post the meme of like, oh no, Bitcoin dropped and fell to $200,000, signaling that, hey, in the past it's done this, it's recovered, and things will continue. Now, even though I tend to be rather optimistic for the long-term outlook of Bitcoin, I do want to clarify that I only invest a small amount of my portfolio in a Bitcoin ETF. I invest what I'm willing to lose, and if it's worth a lot of money in the future, great. And if it's not, that's okay too. It would certainly suck, but I have plenty of other assets to fall back on, though certainly not as much as Warren Buffett, who's currently sitting on a cash pile of $334 billion. That would be nice. In terms of what you could do about this to give you the best chance at coming out ahead profitable, let's start here. Zoom out. Even though it's easy to panic, see your portfolio decline in value and worry what could happen in the future. The reality is we are barely back to the same levels that we saw just a few months ago. Like, here's a chart over the last 6 months, 1 year, and 5 years. You see all those ups and downs? Almost every single one of those was a newsworthy event. And if you go all the way back to the 1990s, over time, those drops made no difference whatsoever. That's why if you want the highest chance of coming out ahead profitable, all you have to do is this. 1, always keep a 3 to 6 month emergency fund at all times. This way, you're not going to have to sell your investments to pay for lifestyle expenses. If you were to lose your job, your income goes down, or something unforeseen comes up when the market is trading at a low. 2, diversify your investments throughout as many different sectors as possible. Just like tech stocks lost 78% of their value in the dot-com bubble, or cryptocurrency fell 85% in 2018. That can happen to you if you're not properly diversified in the event of something catastrophic. This means the more you spread out your money, the more you could reduce your risk and volatility while making sure that you can continue buying in. 3, speaking of buying in, keep buying in. Look, I know it's awful to see your investments drop 20 to 50%, and by the time you should start buying in, you think to yourself, oh no, I'm not going near that ever again. But study after study shows that the best strategy you could implement is simply to keep buying in as usual, stick with the plan, and hold. That of course brings me to number 4, don't panic sell. What I've seen so many times is that the same psychology that pushes you to sell when your investment is down is going to be the same psychology that prevents you from buying back in once it starts going up. So don't be that person. Next, 5th, it's also going to help to keep a steady income. The biggest risk I see in today's economy is that any sort of major drop is probably also going to be associated with unemployment, reductions of income, and just generally everyone scaling back. That's why if you could keep a consistent income, you're going to be that much better insulated. 6, if you're extra paranoid about all of this, keep a little extra cash on the sidelines. Now, I'll admit, statistically, this is not what you should be doing, and it goes against every rule of investing of not trying to time the market, but sometimes for peace of mind, it does help. And if you are that person, it's okay. 7th, it's also important to stay out of margin and debt. I think it's pretty safe to say that unless you really know what you're doing, it's probably a bad idea to borrow money to invest in the stock market or in cryptocurrency. So for 99.9% of people, don't do that. And lastly, number 8, if you need your money over the next 3 to 5 years, it's probably a good idea not to have it invested. The fact is, a few years is just not long enough to ensure that the stock market can recover from any sort of crash. And there are plenty of times in history where the stock market is lower 10 years from now than it is today. So the shorter your investment time frame is, the more likely it should be kept safe and not invested. And look, I get it. Sometimes my videos like this are repetitive. I don't necessarily like remaking the same videos over and over again. I totally understand it, but sometimes it's a requirement to remind people that the slow, steady, boring approach still works and is very much effective. That's not to say the market can't fall 20 to 30% or rally 50%, making everybody rich. But in the short term, it really makes no difference when you're investing for the long run. In fact, the only time that you should be concerned about something like this is if you're within a few years of retirement, in which case you've probably already rebalanced your portfolio to much more safer, stable investment. If you haven't done that, well, yeah, I would be concerned and you're probably F. But again, outside of retiring in the next few years, any short-term drop in price is simply a good opportunity to buy cheaper than you could a few months ago. The reality is, if you could just follow the above and what we've already talked about, you are practically guaranteed to make money in the stock market over the next 20 years, regardless of what happens in the short term. I say this so confidently because over a 20-year holding period, the S&P 500 has never once produced a negative result ever. This means you could quite literally buy in at the very top, go all in right before one of the worst crashes we've ever seen in history, and still make money if you just held long term, with dividends reinvested, of course. This is why my advice is always going to be the exact same. You're never going to hear me say, guys, this is it. This is the time to sell everything. Did you just see what CNN just said about the stock market? Okay, so we're going to sell everything, and then we're going to buy back in once it's fallen 50%. Instead, I just make the same repetitive, boring videos over and over and over again until I'm blue in the face. Ugh. That's it. I hope all of this has helped. For a few of you, it might take a few times of hearing this to sink in. And this is my warning for everybody watching. So if you found this helpful, please do me a favor. Hit the like button and subscribe if you haven't done that already. And if you're feeling extra generous, leave a comment down below because I'll do my best to read and reply to as many of them as I can. So thanks so much. And